All right. Good day, everyone. It's been a minute. It's been a while. It's been almost a month, if not 2 months, since I dropped a video here. I've been super busy, but busy trying to learn new skills and trying to make my technical analysis better. And in that vein, I've added two technical analysis tools to my stack, which are Fibonacci and Elliott Wave technical analysis. So in this video, I want to show you guys how to another way to use RSI. RSI relative strength index. Aside from overbought and oversold region, you can use it with your Elliott wave and your Fibonacci extension to know where the market is actually going to be overbought. It's not that it's like certain, but it gives you a probability, a higher probability of understanding the full perspective of the market. Okay, so today we are going to do it on name insurance. Name insurance has been gaining traction from investors and also the insurance sector index at large also. So yeah, we're on the daily charts. Normally, Elliott wave, when you draw Elliott wave, I usually start from the weekly charts because that gives you an investment and an investor's perspective. So you'll be able to know, oh, what are investors actually thinking, when you're drawing your Elliott wave. And then you now do a top-down analysis, which is a video I've done before, how to do top-down analysis. So you do a top-down analysis to know what's happening in the lower time frame and where to actually put your money, okay, and buy at a pullback. Okay, so this is name insurance. Let me put the candlestick pattern. You can see this is a live chart already. This is a new month. This last candle here, the new month. So we'll just go back in time to see where the insurance company started. Okay, started the not when the insurance company started, when the candlestick started for the company. So it started to 2010, but we can't use all these data because it was consolidating. Yeah, it was very choppy. So we'll be looking for the next uptrend. Okay, as you can see, even when it went up here, it went down very strongly. And normally in Elliott wave, if you are drawing Elliott wave, the it's not meant to go down more than one unless it's wave one, unless it's a big corrective wave. And when it's a big corrective wave, it does know that the next wave is actually number one. So that is it. And also we are also looking for we are looking for our next yeah, we're looking for our next bullish trend, not a down, not a bearish trend. So that is why we look for an uptrend, because mainly in the stock market you mainly buy and you don't sell all the time. So we're going to start from here. Let me put my line here. You can see this blue line that I put here. This is where we're going to start. So I'm going to start from this trend here. So in a Elliott wave, we have five corrective and three we have five impulsive and three corrective waves. So wave one, wave three, wave five are impulsive waves, which have internal waves that you can count as five. Okay, wave two, wave four are corrective wave, which are usually three. They usually come in A B C D E, ABC, which is the popular one, and also XYZ if the correction is being extended, or WXY, sorry, if the correction is being extended. Then when you combine Fibonacci extension and retracements, you use those certain levels to know, okay, where is our wave three? Because wave three is always the longest and the strongest wave. And after wave three, there's usually a divergence. When there's a divergence in the market, then you should know that any uptrend that is going, or if the market is still going up, does know that the market will come down and it will correct massively, because that period is when maybe traders are just trying to, you know, buy into value, but there's no the value, the market has already ended in wave three. Okay. So people that actually bought in wave three will not be taking profits at wave four and wave five. Why buyers, emotional buyers will buy at wave five, and then it can lead to a corrective wave. However, in our stock market, Nigerian stock exchange market, I've not seen any market in this, let's say, last 2 years, that when it corrects so strongly that you look at your pockets, you're like, no, I can't invest here. So the correction is not always too big. Just when you know where to place your money, and using the Fibonacci retracements to know possible support and resistance levels. Okay, so that's that for explaining the Elliott Wave and Fibonacci extensions, retracements and extensions. So we are going to now draw this Elliott Wave. Just looking at this, I can say this is 1, 2, 3. It could be 4. It could be 5. However, let's check let's check our let's first start with Fibonacci retracement. Okay, so I'll bring up the Fibonacci retracement to know where did wave one start, where did wave one start and end, where did wave two start and end. So when you are using it, you draw it to the end of the final trend, which is here. I want to extend this so that you can see what I'm doing. All right, so as you can see, the market went up. This is a 1, 2, 3, 4 and 5. Even though the market came up again, so this 5 now will stop here. Let me put it here. The 5 stops here. Now this is now a flat. This is A, B, and this is C, and the connector. Then this is now when we now talk about WXY, because this is a very strong corrective wave here. Okay, so if we want to count it from here, we can say this is WXY. Let me put it so I can see what I'm saying. Where is it? All right, so we start from here. Is W, X, and Y. This is a complex corrective structure. Okay, so but this is not what we are going to do now. So we are going to now label our 1, 2, 3, 4, 5 wave. So we already know where wave 2 stopped here. Now where did wave 3 stop? We will bring our Fibonacci extension to know where wave 3 stops. As I'm doing this, I'll say why did I say wave 1 stopped here? Sorry, wave 2 stopped here. Normally in retracement, when you're looking at the Fibonacci sequence, retracement usually comes in between 3.0.328, 0.5, or 0.618. Sometimes it goes to 0.786, or if you know it by percentage, you can say 38.2%, 50%, 61.8%, and 78.6%. So those are the levels for retracement. And again, wave 2 must never ever go below wave 1. So this where these are ways to stop actually follows all those rules. So now I'm going to stop here. Okay, let me extend this so we can look at it well. All right, so this is one, two. Sorry, this is one. This is two. Okay, three should have stopped here, but normally three is usually the longest. Now this is where you now bring up the RSI to know where the three actually stop. The normal rule is that three must always cross this 1.618 to show that it's a very strong bullish market. But sometimes you see that three actually stops at one. Sometimes you see that three stops at one. Okay, and then goes on a five, four, five. Another way to identify a three is that you see a gap. You can see this very long gap from year to year. Doesn't know that this is where the three ended, 2.618. That means it extended very well. Now let's use our RSI. So this RSI, this is where I said wave one ended here, because this is one, two, three. This is wave three of wave one. That is why it's very strong here. As you can see, this divergence here. This is where wave one actually ended. You can see this divergence, so that the trend actually ended and is going to a wave two. Let me put a line there so you can see what I'm saying. So starting from here, you can see a divergence going on a downtrend. Okay, so wave of wave three of wave one actually was the highest here. Then it came down to this place, and it continued going on this downtrend. Okay, continued going on this downtrend until it broke out here, but it continued going on downtrend. And you can see that WXY that I said that time when it came here, then it came up here. This is X and this is Y. It came down again. So now, how about our number three? This is one. This is one. One means 100. Okay, is another way to say 100. So number three should always pass this one, or 100%, and usually 100% of 100% of wave one and two, or 1.618. But normally the most popular one is 1.618, and that is not really a standard rule, but is a rule of thumb that you can use to guide your analysis, so that you don't label a very short wave three, because wave three is always very impulsive, and the longest and the strongest comes with a good strong volume. Okay, so we can see that it actually spiked up here. So we could have said this is going to be our wave three, but at the end of the day, the market retraced massively. Retraced massively and started consolidating here, and then another strong bull run. As you can see, let me put a line here. As you can see, another higher high was made, which was higher than this. So I can say this is wave three and this is wave five, because wave five always comes with divergence. Okay, so let me zoom in very well so I can see. As you can see, let me even adjust this one here. So as you can see, yeah, so as you can see, this is a higher high. It's higher than this, and this is the end of wave three. So after it's wave three, now you can see that divergence. You can see the divergence coming down. Okay, and that's what we count our wave five. Either wave five is ending here or here, where my cursor is. So let's check. If this is wave three, where this gap is, then where is wave five? Wave five is usually 100% of and um, one and two, or wave five is always equal to wave one. So if I put this here, because this is a retracement here, this is one, two, three. This is wave four. So wave three, wave four. Now you can see that wave five actually came here and rejected. So if you want to count it, this is one, two, can see it didn't cross here. 2, this is 3, and this is 4, this is 5. As you can see also, you can see also see how it's choppy, trying to struggle to go up. That's why it's called that's why the wave 5 doesn't come with volume, and that's why there's always divergence. Okay, that's why there's always divergence. So we can say wave 5 can also stop at this 0.618. Now see, it also went down here. Okay, 1, 2, 3. Or if you want to say 1, 2, 3, this is 1, 2, 3, 4, 5. You can see the wave. If you want to count another 5 wave for another wave 1, you can see it's not like up to this. You can see that it's actually crossing. It went below. So I would say 5 ended here. Then we have our corrective wave here. Then we have a new trend here. And you can see that anytime there's a new trend, it also always ends with either a doji candlestick or a tweezer, bullish tweezer, or engulfing bullish candle to show that, oh, this is where the trend actually ends. So I'm going to use this place as 5. Okay, 1, 2, 3, 5. Okay, so let me draw the Elliott wave now. All right, so we start from 1. This is 1. Remember, this is our 2 using the Fibonacci retracement. Then our 3. Our 3 is here. C, corresponding with RSI higher high. Then you can see it now that's when you now say, oh, market is now overbought. Using that level of Fibonacci, which is 1.618, to determine. Sometimes the 3 set can extend to 3 or 4 or 6 points. 6 points. 618. Okay, this is 4. You can see, as I said before, when there's a reversal, potential reversal, the market is either ends in doji candle or any candlestick pattern, that you know. Okay, this 1, 2, 4, and this is 5. You can see price actually rejected here at this 100% level. So this is where we stop. Okay, okay, all right. So as you can see from this 3 here, let me show you the divergence now for this first wave we just drew down. From here, you can see that it was going on a lower low, the divergence. You can see how it was going down even when the price was going up, but you can see RSI is going down, just to show you that an upcoming bearish trend is on the way. So when you see divergence like that on RSI, just know that it's an upcoming bearish signal is on the way, and it always comes with low volume, with 5 low volume. And you can see that people are taking massive profits here after this, 3 long run. People are taking profits and still taking profits. So This is divergence here. Now let's finish counting the waves. Let me remove this. Okay, so we have our first 1, 2, 3, 4, 5. Now let's count another wave. Okay, corrective wave now. This is going to be ABC because it's not a deep correction. So this is A, B, and C. Maybe bring that one out here. Okay, ABC. Then we'll now start with another wave count. So this is where our one will be. As you can see, where let me make this thing. You can see this tweezer bottom, and you can see it's also on a support level. Hmm? Let me draw the support line here. Make it a bit thick so I can see. So you can see this support level here. That is why this is a very strong support level. And you can see this was also a former resistance for even number three self. So starting from here is actually a good number one. Okay, and you can see this is one already, and this is two should end around here. So we're going to start counting from here. Okay, you can see it's making this is they call it leading diagonal. If you draw line here and you draw another line, price keeps hitting and going up. So they call it leading diagonal before a strong uptrend. All right, let's bring our retracements, Fibonacci retracements, so we can. Okay, you can see price rejected. It came 50, then 0.6, but it did not go any further again. Okay, so this is where our two ended. I ended here, or yeah, no, I ended here, and this will be. And this is only the same line. Keep it 1, 2, 3. This is where this where indecisive candle is where our two actually ended. You can look at the price 7.5, 7.5, open, close, high, low. If you look at that place, you can see 7.5, 7.5. So this is where our two ended, and this is where our next trend will start. So let me bring Fibonacci extension to know where our three will be, starting from here to here and here. Now, as I said before, this 1 or 100% is usually an ideal place for three. Sometimes you can find it there. You can see it consolidated here. It just means people took profit around here. Okay, then it went up again on a strong uptrend. So I will actually label this place a three, and let's see how far if our RSI agrees to that. As you can see in this new trend, this is this place is just the wave three of the third wave. So after this one, you can see that there's a brief divergence because of this stock market, but the market went up again. Normally, if this is wave three, this will go on a down, just like how we have it here. To go on a serious downtrend, divergence to signal market reversal, but it did not. Instead, it went on another higher high and created another higher high. Yeah. So let me bring this down. This is a new wave. So creating another higher high in this place, which makes this place a probably good spot for number three wave. Okay, and it's almost equal to our former number three. So okay. So now we're going to, if three ended here, you can see that the Fibonacci extension, it broke out the Fibonacci extension and went up, before this strong pullback. So now this is what I'm going to do. We'll extend it. Will extend the Fibonacci extension. Okay. Where was the best possible place it actually ended? Okay. All right. So 5.618. You can see the price ended, stopped at 5.618, exactly at that place, and went down. And usually when wave 3 extends like this, wave 5 is usually either it truncates. That means it goes up. Instead of wave 5 to pass wave 3, it doesn't pass that level, and then it goes on a what do you call it? It goes on a bearish market for a bullish market or bullish run. All right. So this we have seen our is our one, two, three. Sorry, this is our one, two, three. You can see four. You can see, and you can see again another. Let me show you. Let me make this a bit wider. You can see where this ended. This four ended a bullish engulfing candle. Okay, just to show that this is where it ended. So this is one, two, three, and one, two, three, and one, two, four, five, 335. They call this this is a flat. If it's a zigzag, it's going to be 535. Okay, but 335 is usually a a flat. So this will be ABC. Okay, now after this if is 3 4, then this is 5. So what 5 is like 1, this is wave 2 of wave 5. Now we're entering wave 3 of wave 5. So we'll use this one to also project where we think the price should actually stop if we invest it, and know where to enter in this current market. After all this analysis, you can't just say, okay, yeah, we know it then. But yeah, where are we going to enter? No, no place to show. Okay, so we'll put our Fibonacci extension at the end of uh, 3, where 3 ended, and we put it here, end of 4. And as you can see, we can project here 0.618 because this our wave 3 was very long, or we can also project 100%, which we can't see now because the market hasn't reached that level yet. So let me draw the Elliott waves. Going to be 1, 2. Four. So this is where 5 should end. 5 should end here. So looking at this current price, where are we supposed to invest? We will know very soon. Now we are going to use our Fibonacci retracement to know where we're supposed to enter in this current market. Okay, so now we have our next 3 waves. Okay, So this is 1, 2, 3, 4, 5 correction. We have 1, 2, 3, 4, 5. This is where 5 should end, around this 40 naira area. So coming from here to here will give you like a 3.3%. 30 from 30 to like 40, it's like a 3.3% gain, which is actually good. Then the market will correct itself a bit before it goes up again. Given the good sentiment for name insurance, the market is meant to continue on its strong uptrend. Okay, so you can see our wave three is 1, 2, 3. You can see wave three of wave three that was strong, and this is 4. You can't say wave three actually ended here or here because of this RSI actually performed a higher high. So let's do a measurement now. Let's use Fibonacci extension to measure this. So you put this here and here. As you can see, wave 3, which is always the longest wave in an Elliott wave, actually broke out this our Fibonacci. Normally, it's supposed to either it ends here. See, as you can see, it's supposed to end here, but it didn't. It actually went on another bull run. That is just to show that at that moment the market had there was a positive sentiment in the market. But you can see after this bull run, the market pulled back very strongly. Okay, so anybody that entered at this level was um late. So it was better you started from here or where this market consolidated here at this one level. Okay, so this Fibonacci extension broke our Fibonacci. So what we are going to do is we are going to add 5.618, because what our Fibonacci is that it's usually subjective. So you should be able to adjust. The important thing is that you should know when the market is correcting and when the market is on an impulse wave. Okay, you can see when the market goes up like this, is impulsive. This is corrective. This was one, and this is wave one for an impulsive. This is wave two, and then we are going to enter the third wave, and this is going to be a third wave of the fifth wave. And as expected, it's supposed to stop around either 0.618 or 1, which is 100%. Okay, we can't see the level of 1 where 1 will be. So what I'll say is this 5 now will stop at this, yeah, 40.769 naira. Okay, so if you invested from here, from this low here to this place, as I said earlier, is 33%. So how will you know when to enter the market? You will use your Fibonacci retracement to know where markets will actually bounce from. Then we'll use our retracement either 0.5, 0.38, or 0.618 to know where the market actually uh will sub will bounce back for a bull run. Using Fibonacci retracement is almost like using support and resistance line. Okay, gives you a better probability of where the market will extend to. So as you can see, drawing it from this end of from the beginning of 5 year, which is the end of our wave 4, which is corrective wave, and to the beginning, to the end of the first wave of wave 5, you can see the market actually pulled back, and it pulled back to 0.618. You might not be able to see it clearly. Let's see if I can zoom it a bit. But this is where it pulled back to, this place, which is 28 naira. So it pulled back to this 0.618 and rejected. And anytime you're trading your technical analysis and you see that market is rejecting one Fibonacci sequence, just know that people are actually buying at that place at a discount, buying into value, and it would be a good place to actually place your own bets. So as you can see, it rejected at 0.618 and continued going up, and you can see it actually went, you know, uh, is still trying to, break this resistance level here. That's why you are seeing a bear candle. There's a brief resistance level here. So it's trying to break it and then go up to this our 44 level. So at the moment, this is still a good place to invest um your money, because the prospect for this stock is 40 naira, which is 33% gain. Okay. So after that, I think that is all. Using the RSI to know where the market is actually overbought and oversold, and combining it with Fibonacci sequence and Elliott Wave. Is that will give you a very good picture of, okay, where is the market now? Is it in a consolidating area? Is it retracing, or is it in an uptrend? And just like how I said, look at it from here. Though it has not yet completed, you can see the market is still in this neutral area, but there's a divergence because of this our corrective wave. And the market tries to come up a bit in wave 5. So we should expect that wave 5 should hit 0.618 or extend to 1. Okay, 1 might be maybe 45 naira or so, but I can't see it now because the market hasn't gone that far. Okay, so that is it for now. I think I will be doing videos later in the future on continuing the beginners course for the stock exchange, for trading Nigerian stock exchange, and then what else? I think I will, yeah, I'll do also an advanced indicator series or trading series for those that want to advance their trading in Nigerian stock exchange market using tools like Fibonacci, Elliott Wave, and all the indicators. Okay. Yeah.